Hi, and welcome to Macro Wednesday. We talk macro, try to make sense of markets that, well, they really don't make any sense. And more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for joining me today. Have I got a great show lined up for you today? Now, apparently on Monday, I must have struck a chord with some people when I said, pal, no, you can't print money, even though, as we know, he went on 60 Minutes and said he can print money, which completely contradicts all the other times he said that he doesn't print money. And of course, we know for a fact he can't. But a number of you didn't like that. And I got messages saying, no, he can, the Fed does print, and so on and so forth. And this made me think about a story that I wanted to tell you, and you're going to see how we're going to tie it back to monetary policy. Because what I want to do is take a different approach. Maybe the way I've shown you, I'm going to show you a different way today. But when I was a little kid, there was an up-and-coming illusionist. I was going to say magical, but that's not the right word. Illusionist, David Copperfield. Now, he came to my town, which isn't really a big town. And as a little kid, I remember seeing him on stage and being amazed of all the things that he could do. And as a little kid, all of it is absolutely real. But we know magic isn't real. We know it's illusion. We know this. It's a fact. But where does magic really happen? It doesn't happen on the stage. It happens right here. It happens right here. So when that little kid went home, me, and laid in bed that night and was wowed that he could make things disappear or whatever he did. I don't remember his show. I just remember being there and being completely amazed. It was real. But we know he can't make a coin disappear. What we can't see is him slipping it in his coat pocket. And where I'm going with this is the world's greatest illusionist is the Federal Reserve and central bankers. Because every day they're trying to convince us that they're doing something that they're not doing. So when Fed Chair Powell came out and said he is printing money, which he is not doing, he wants us to believe he is printing money. He's focusing right here because he knows what the Federal Reserve Act says. He's been on the board for so long, he knows the rules. He knows what he can and can't do. But as long as we believe he can print money, how does that change our behavior? See, if the Fed could print money, which they can't, but let's say they could, well, what would that mean from an investment standpoint? What would I want to do? Well, I would want to get rid of all my bonds, right? Because that means interest rates are going to go up, and I would probably want to buy stocks while I was at it. And what else would I do? Well, I'd be really bullish about commodities because they generally go up when inflation goes up. So he wants people to buy risk assets. Now, why would he want people to do that? Not because he can make them magically elevate. Because what happens to people's spending when they feel richer? They spend more money. It's simple. This we've known for a long time. Consumer spending is directly related to how bullish your bank account is, or your investment accounts, or all of the above. What else would it make us do? It would cause inflation to happen. And as consumers, if we really believed that inflation was coming, if we really believed that interest rates were going to go up, what would we do? We would run out and get a loan and buy a bunch of stuff. Homes, cars, TVs, electronics, everything. Why? Because we're going to borrow money now while interest rates are low and buy stuff before prices go way up. That's the whole point. And if we believe him, if we buy into the illusion, it can become a self-fulfilling prophecy. Because that little boy, when he walked out and saw David Copperfield out there, taking pictures with people and doing signatures, he believed he could make things disappear. He did. I was him. I believed it. That I wanted to know how a person could have such power. Of course, part of me knew it wasn't real, but I wanted to believe. And so we believe as investors the biggest lie in the world, and that is that central banks like the Fed are printing money when the laws clearly say they can't. So I've shown you this, and I want to kind of go back to it, because how do we know Copperfield can't make stuff disappear? Well, one, we know he can't. But the second way is people over the years have come out and shown how a lot of these tricks and illusions are done. And we go, oh, God, why didn't I see it? That's the point. You didn't see it. It wouldn't be magic if every magician came out and said, look, I got a great trick for you, and let me show you step by step how it's done. No one would go to those shows. What would be the point? The magic is here. So I'm showing you how the trick is done. Let's go back and look at it. So everyone believes the Fed prints money when they don't. The Fed buys U.S. Treasuries via quantitative easing. Now, why do we use terms like quantitative easing? Because no one knows what that is. It's like this term liquidity. I'm getting sick and tired of hearing, well, the Fed is injecting liquidity. I'm getting tired of hearing presidents, and no, I'm not picking on Trump because he's not the first nor the last president to use the term liquidity. But people are running around going, oh, look at all this liquidity. They don't even know what they're talking about. In fact, today on Twitter, I saw some traders saying, look, markets don't go up on fundamentals. They go up on liquidity. You shouldn't fight the Fed. He doesn't even know what he was talking about. It's just some buzzword that no one has a clue. But they think, wow, the Fed's injecting liquidity. I mean, when the New York Stock Exchange opened in the morning, does there somebody there that has a measuring stick that says, well, what did happen with liquidity last night? Oh, liquidity went up? Great. Well, let's everybody raise your stock price 1% because liquidity went up. No, it doesn't work like that. But nevertheless, people think. So here's what happens. In the cycle, the Fed buys U.S. Treasuries via this quantitative easing program that no one knows what it means or does, but they think they do, from large commercial banks. That money goes, the cash from the sale is held at federal accounts held at the Federal Reserve banks. It does not go back to the banks. It just, think of it as an account held in the name of. The money does not flow back to the federal government. There's an X here. There's an X here. There's no money that flows back to the federal government. And we know that because when we look at where the money goes, we can see it in the monetary base data. So here's the weekly monetary base data that's actually updated every other week. But nevertheless, here it is. And we can go down to the monetary base and we can click on this thing that says total balances maintained at Federal Reserve banks. And lo and behold, this is quantitative easing. You'll notice why it was pretty much flat. They didn't really do anything with it. Now, they did something with it back during the Great Depression. But look, they really didn't do anything with it until quantitative easing 1, 2, 3, and now whatever we're calling this whole mess here. This is the trick, my friends. This is how they're actually doing it. But see, people look at that and say, well, that's not right. So let's look at this from a whole different perspective. What is money printing? Well, money printing would occur when the U.S. Treasury issues debt and the Fed actually comes and buys it at the weekly auctions. Now, we know they don't because of Treasury, every time there's an auction, releases all the data on what happened and who bought what. Not specifically like, hey, Steve showed up and bought. No, it's generic. Domestic bidders, foreign bidders. The Fed does not go there and buy. They can't. So if the Fed did buy debt directly from the Treasury, that would be money printing. They don't do it. They can't do it. It's not legal. That's how we know that whatever this scheme of quantitative easing or quantitative, the next thing they're going to call whatever the next scheme is, it still isn't money printing. It's all designed to get you to think that it is, so you will change your behavior. This is why I like to use that example of the Bureau of Labor Statistics fudging employment numbers back when Reagan was facing a double-dip recession, because the government figured out that if they lie, People will change their behavior as long as they believe the lie is true. And that's why we have revisions to data. That's why we use lagging data. And that's why sometimes we come back a year later and we're like, oh, whoops, we were off by a zero there. There wasn't 100,000 people that were out of work. It was 1 million, but whatever. As long as people believe, they will spend accordingly. And so the Fed right now is desperate to get people to believe. He is desperate to get people to buy stocks, because if people buy stocks, we should see that funnel back into the economy. And this is why I like to look at some of the weekly data. And so I thought I'd take a little time today and show you some of the things that I like to look at that really most other people don't. And one of the things that comes out every Tuesday, see, we'll go Tuesday, and I'm on the investing.com website under news, economic calendar, so you can access this and you can see they track stuff all over the world. But in the US, the one thing I look forward on Tuesday is Redbook same-store weekly sales. This is unlike the Fed data or the government data, which comes out monthly and then is revised backwards as they need to. This is same-store weekly sales. And so we can look at this week from prior month and this week from last year. And what I'm looking for is all of these green shoots that everybody is talking about. Well, from this week last month, same-store sales fell 2.6%. And from this week last year, they fell 9.5%. This is the previous week. This tells me that despite all this talk about pent-up demand and everyone wanting to spend money, it's not showing up here yet. Now, maybe it will, but it's not here yet. The other thing that I find interesting is what's going on in the mortgage business. And I like to look at what's going on with applications. They were down 2.6%. Now, these fluctuate pretty wildly, but I kind of look at the trends. What I find interesting is the purchase index has steadily been increasing. So it's not a big market in terms of compared to refi, but there's been some slight increase here, and it's getting back to the recent highs. Now, how does that relate? Well, you can see the housing bubble was way up there. But people are still out purchasing homes, and that's kind of interesting to me. But the refinance index continues to slow. So what we see here is there are people that still have jobs that are moving and buying homes, whether they're buying bigger homes or smaller homes, we don't know. But the refinance data is interesting to me because this is telling me what's going on with the trend. And we can see the refinance trend has been falling. It looks really high, but again, everything's relative to prior cycles. And you can see that following the dot-com bubble, there was a lot of refinances, and then following the years following the great financial crisis, there were. So we see an elevated number here, but they're tapering off. And why is that interesting? Because people that get unemployment benefits cannot get loans. So how would we know things are getting fixed? We need world all liquidity to get fixed. And how would we do that? We need to see people borrowing money and buying foreign goods. So let's say someone took refinanced their house, cashed out some equity, and went and bought a German or Japanese car or Italian, it doesn't matter. Anything produced anywhere else in the world but here, yes, that would be what we'd want to see. Instead, what are we seeing people refine their houses for? They need money. They're trying to get their payment down, or they're trying to pull equity out before their job was lost to pay their bills. This is not fixing things. But the fact that it's trending down tells me pretty much what I know. There's lots of people on unemployment, and they're not going to get their houses refied. So those are kind of some of the data points I like to look at. Let's take also a look today at some very, very lagged data, but it does kind of help answer some questions. And this is major foreign holders of Treasury securities. Now, you can tell the most recent one that came out earlier this week is from March. So it's very old compared to the big world of things. And what we can see in March is more than $250 billion worth of Treasury securities were sold between February and March. Now, we had a hunch that something like this happened because we knew there was a liquidity crisis. And we can go down here and look. Well, about 20 billion of it was Treasury bills, but most of it was long-term notes and bonds. So if we take that information and we go and look at a chart of, say, Treasury yields, We can zoom back to, oh, we're okay. Let's go to 10-year Treasury yields, and we can see this big spike in yields. Now, what was going on here is foreign central banks were short dollars. There was a liquidity, a legitimately used word, liquidity crisis that sent yields higher. And the Fed had to come in with their big money printing machine that isn't really printing money. But nevertheless, that's what you're comfortable with. We'll go with it for the moment. And they bought a bunch of that to bring yields back down. So we knew that happened, and we can go and look at charts like TLT, where it's really obvious. You can see that bond prices fell as foreign central banks were forced to unload. The Fed comes in and mops all of that up and brings bond prices higher. So we do know that when the Fed buys, they can cause interest rates and do cause interest rates to fall. Now, what's really cool is we are going to wrap this whole quantitative easing thing up on Friday. So it was kind of like a 3-part series. If you're new to the show, go back and look at the last 2 Fridays. You can just fast forward to the part where we talk about how quantitative easing works, because I'm really trying to break down how the illusion works. Because once you know how it works, as a macro investor or just someone who's interested in macro in general, you could be a day trader and still find macro interesting, because it tells us a lot of things. That what the Fed is doing is not working to the intent they want. It appears to be working because, again, people believe it is, so they're out doing things to make it look like it's working, right? I'm buying people. Let me rephrase that sentence. People are buying stocks because they think the Fed's printing money, which is a self-fulfilling prophecy. Are we seeing any data or economic data that is telling us that it's doing anything? No. Are we seeing any other data based on what the Fed's doing to show it's doing anything? No. But for the moment, people believe. And that's one of the challenges when it comes to investing is people believe. And you wonder why so many people get on the wrong side of markets. It's because they believe in the wrong thing. They read that, like that guy on Twitter said, don't fight the Fed. If they're pumping liquidity, you buy. Doesn't even know what he was talking about. Doesn't understand the term liquidity. The Fed isn't putting liquidity into the system at all. They're just trying to make you think they're doing it, and no one knows what that means. What they actually did is they contracted world dollar liquidity. They do know what they did. They reduced the pool of dollars. That's what this chart right here says. They reduced the global trade cycle. Now they're trying to fix it. The problem is they can't. The Fed does not have the ability to fix it. They have the ability to make it worse, but they don't have the ability to fix it. So as long as they can convince people that they do, maybe that will fix itself if people go out and spend. But it's really hard for Americans to go out and spend money in foreign goods when over 30 million people are collecting unemployment benefits. I mean, it just is a fact of when you're working the macro world, you have to wear your economist hat and just things are what they are. Most people that are receiving these benefits, yes, I know lots of people are receiving more money than they were at work, but if you think they're out spending it like crazy, no. I bet most of them are saving it because they're not sure if their job will be back. They're not sure if the number of hours they had will be the same. They don't know. They don't know. And that's why they're hanging on to that money. They're not going to be out spending. Now, if the world went all magically back to normal, sure, we would probably see that money get spent. But remember, the Fed is the greatest illusionist in the world. And as long as they can convince you to believe it, it might actually work. But that's why these bear market rallies turn into massive bear market crashes in stock prices, because once it's clear the emperor has no clothes and they can't stop it, the deflation, the party's over. The world just hasn't figured it out yet. Investors believe again, and they'll believe it until it's too late. All right, so let's look at some charts, and then we'll get to some questions. We've got quite a bit of those. So one thing of interest to me is obviously Treasury yields, because one thing you have, as we talk about on this channel, is a relationship between stock prices and Treasury yields. So when stock prices are rising, yields need to go up too. Well, what are yields doing? They're kind of going sideways. So if they go back down, which I believe that they will, because what the Fed is doing is deflationary, we know stock prices will likely head lower. And we can look at a chart of 30-year yields, and we can simply overlay the S&P 500, and we can see there's a gap. These are called jaws. So these are teeth. These are alligator jaws. Here's your some teeth. And if we zoom out a little bit, we can see that there's a really big gap. And the phrase you'll hear people in the industry say, the jaws must close. Well, here's the jaw. And look, yields went down and stock prices went down. So right now, the market needs to get yields up to validate rising stock prices. So they keep pushing prices higher, keep trying to push prices higher to get people to sell bonds. The problem is no one has them. I mean, yeah, I know the government's issuing a ton of them, but they're still, most investors don't own them. So we know hedge funds are deeply short long bond. We know most investors don't own them. We know most professional money managers hardly own any treasuries now. They're trying to push stock prices higher to force interest rates up. They're trying to make inflation happen. They're trying to validate everything. When it doesn't, then stock prices head lower. So we know stock prices are going to head lower because we know interest rates are going to head lower because we know that quantitative easing, as we talked about last Friday, is deflationary. And we're going to dig into that deeper again this coming Friday. And even though my chart here is not on yields is not exactly accurate, what we can see is Treasury yields are in what's called a consolidation pattern. So when you see a chart that goes sideways like this, it is generally what's called a consolidation pattern, where buyers and sellers are duking it out, and the general direction this follows is whatever the trend was before. So consolidation patterns usually they usually follow whatever the prevailing trend is. We know the prevailing trend is lower. We know the Fed is causing deflation, so yields have a high probability of going lower. Now, if this was a bottom, it will take longer, and we will most likely see a revisit somewhere down here of the prior lows. So we can say, hey, that was a bottom. Maybe we get 2 visits or 3 visits down there, and then you see a spike higher in yields. But we know that this move higher in stock prices isn't validated because yields should be spiking higher every day. They're not. So we're stuck in this channel. And what we know is the next time, hopefully, yields break 1.2% on the 30-year, that will signal the move down. I was hoping it would happen here. It didn't. The market wasn't ready for that. Sellers weren't ready, so they sold it up to here, got rejected, really fought to get it up here, and now we're seeing, once again, rejection going on. So we can kind of look at that in a more granular sense on TLT, only because my chart is a lot more accurate, and we can kind of zoom in a bit more and see that I've drawn these purple lines. For those of you who are new and do not know what technical analysis is, below this purple line here, you can pretty much see where the buyer is at. So buyers have been happy to buy down under here. Sellers have been happy to sell up here. And we know, as we zoom in a little bit more, that there's been selling here, all the way from the top down, selling here and selling here. So as buyers come in and push prices up, sellers have to what's called defend. They have to defend their positions. If they have run out of steam or out of ammunition, then they will eventually get squeezed out of those shorts, become buyers, and that will send bond prices higher. Now, if you're confused about the likely direction of this, well, it's really simple. The Fed's buying bonds, and lots of them. They will prevail. I'm going to give you the big secret of how they do. I'm going to share with you on Friday how the Fed creates the biggest short squeeze ever in the bond market and why this thing always blows up against what everybody says. I figured it out. In fact, some of you said, hey, your graphics are kind of suck. And I was like, yeah, I'm not very good at drawing pictures. So I made some kind of funny PowerPoints. At least I think they're funny. Anyways, I made some this weekend to illustrate something, but I'm going to give you the bottom line and the real reason how the Fed causes the ultimate short squeeze. And this is why, if you look, and as we look at every Monday, why hedge funds are short the market, but more importantly, why is the smart money long bonds? Because they know this. They know. So this consolidation pattern will continue as long as it needs to. But based on what we know right now, that the fact that it is holding what's called support down here, the buyers are defending the support level, that this should make another run toward the 1.2. And if it can finally get through and break there, that should be the big bond bull market that in my opinion, will take Treasury yields all the way down to zero or very, very close to zero. And that will open up a lot of doors in risk assets for those who are looking to buy low. Because one thing that's really important, people can chase trends, but the easiest thing to do, I even tell my clients this, I can make you the most money when I buy at the bottom. I can chase trends, but when you play chase, sometimes you find yourself on the wrong side. It's very difficult to lose money when you buy near the bottom. Sure, it might go down a little after you buy it, but there is a point where it's not going any lower. Most wealth in this world is created buying low, not chasing swings at the high. All right, let's get to some of your questions. And just as a reminder, I've gotten a bunch of questions for the Monday special. And for those of you who are new, and I remember what my third rule was. I finally remember. So on Monday, which is Memorial Day here in the United States for our foreign friends, and markets are closed, so normally I don't do a video. But what I'm going to do is Friday, after I record the Friday video, I'm going to immediately turn around and just do Q&A. So I'm going to call it my Memorial Day Q&A marathon, and you can submit questions. And what's really interesting, I have some questions I didn't expect I'd get. So it's kind of cool. You're going to get to see what those are. But here are the 3 rules. No trading advice. And what do I mean by no trading advice? If you put symbols in your messages to me, which you can send by email, Facebook, or LinkedIn, any one of those is fine. But if I see things like, hey, Steve, at what price level do you think you'd be selling TLT? Or do you have a price target of TLT? These are the most common ones I get. If I see a symbol in your email, there is a high probability I will not answer the question. I will simply write you back and say, hello, so-and-so, please rephrase your question in a generic sense. I, by law, my license says I cannot give you trading advice because you're not a client of my firm. And since anybody could watch this, and they're not clients of my firm, as my compliance officer is nodding his head right now, I can't answer it. Ask the question generically, and do not ask me for a specific target. So you could say, where do you think yields are going? Where do you think crude oil, commodities, be generic? That's key. Where do you think bond prices are going? Don't ask me what I think they're going to do next week, but what do you think is going on? And I will give you some sort of general answer and a vague reference to my opinion of time, which I'll probably be wrong about. Rule number 2, which I remembered, and then I just forgot. Darn it. I was promised myself I would not forget rule number 2. So there's no trading advice. Oh, I remember now. I have to be able to answer the question that you ask or have an opinion about it. And unfortunately, I don't know the answer to everything. I don't do derivatives. I don't trade futures. I don't know stuff about that. And I'm surprised. I have quite a few foreign friends out there in Europe, Australia. So, hey, thanks for being here with us. And the most common question, I've gotten several questions of, what do you think gold will do priced in my local currency? I have no clue. I have no clue. So the second rule is, if I can't answer your questions, I will politely respond and say, hey, I can't answer your question. If you could, somehow put it in a way I could try to answer it, I will try. Rule number 3, if you do not put your name or a made up name, I don't care, I won't know, but at least put your name on your message. So when I write back, I don't have to write back, hey, big dog, woof, woof, woof. I mean, it's really kind of embarrassing for you that I will do that. So I have a rule. Put your name. Mine is Steve. Nice to meet you. Thanks for being on my show today. And you'll get your question answered. So Monday, marathon questions. So let's get to your questions that I've got lined up. Some of these are, I got to get caught up. You've spoken about how QE is not inflationary because the funds sit as bank reserves and don't get out in the economy until banks lend it out. Now, specifically, the banks can use this as collateral. They can't directly lend the money out. The banks have to decide if they want to risk their capital, and a borrower has to decide if they want to risk their capital. But effectively correct, this money just sits there. Since banks have been allowed to wade into the investment world after the repeal of Glass-Steagall around 20 years ago, are they allowed to speculate with any of these funds to trade in the markets? No, they're not. Next question. I agree with you on the issue that QE brings on lower yields and deflation. Cool. I actually agree with you on almost everything you talk about. You're my new best friend. So, yeah, really. My question to you is, aren't there elements of QE that can raise stock prices, at least in the short term? No, it's all psychological. There's absolutely no transmission mechanism, period, that money from QE touches the stock market. I've shown you it goes into the monetary base. I've shown you exactly where it goes. There's not one penny that transmits there. And that's ultimately why it didn't work. So you go back and look at 1930. We did QE. Then I'll be like, we did? Yeah, we did QE. They didn't call it QE, but they did it. It didn't work. In fact, at first, like, oh, look, we're doing this. Whatever, they didn't call it QE, but they were buying bonds. Like the central bank was like, this is going to work. And immediately, at first it worked because people thought it was going to work. And then when it didn't actually work, because it doesn't work, then people didn't believe in it anymore. And when you listen to people like former Fed Chair Ben Bernanke say that the Fed of the 1930s didn't do enough that we could do today to starve off the Great Depression, my opinion is people stop believing. Because when you stop believing, then the system falls apart. So what's going to happen this time when everyone figures out that quantitative easing at this ridiculous scale that we're doing doesn't work? Wonder where stock prices are headed. Well, we already know that. Well, we hear this term TINA. There is no alternative, and investors such as pension funds and many other investors are seeking yield. This is correct. This is one of the problems with low interest rate environments. QE does succeed in bringing down yields, as you pointed out, and as central banks have brought their massive amounts of demand for sovereign debt, investors who want or need yield are forced into longer maturities, correct, riskier fixed income securities, correct, and are stocks that pay a dividend, which is oftentimes higher than treasuries, bonds, etc. Absolutely correct. Much of the sovereign debt around the world is negative, as we know. And those are true. The problem, and that is the problem, by going to these negative interest rates or low interest rates policies, we're forced pension funds, institutional money managers, retail investors, everybody to take risk. And then we kind of sit back and say, well, why is the Fed so obsessed with the stock market? Because if the stock market goes, everybody loses. I mean, there's not many board games where everybody on the board loses, but that's one of them. The amount of household wealth tied up in the stock market right now, all-time high. Historical all-time high. That's why they're obsessed with it, because they force people to do something they shouldn't do. If interest rates were normalized around, if you could go out and get a treasury of 5 or 6%, you would not have so much money in the market because people wouldn't do it. So the Fed, to create inflation, which they can't do, lowered interest rates, which push people into risk assets because there's quote unquote no alternative. Then they have these massive recessions, and then they get worse and worse. There's a reason the great financial crisis was worse than dot-com bubble. There's reasons this next one will be worse because it's going to affect more people. So yes, that great question. Glad we agree on almost everything I talk about. That's really cool. Does the government use a lower rate of inflation than the real one when calculating Social Security? Yes. If we are at retirement age and are planning to live a very long time, should we consider inflation and a chance at government default when choosing to take Social Security benefits? All right, here's my advice, because you teach a class on this, and there's a video on YouTube. You can go find it. Wait till age 70 if you can to draw. That's number one, to make sure it's going to be there. You don't have to worry about default, because with Social Security, what they'll do, if there's no way to fix the system, the benefits will just drop. I don't know if I cover it in my video, but I think around 2034, benefits drop to approximately 70% of their current value or something like that if no reform is done. So no, you don't have to worry about default. It's just the system will come down to whatever there is money flowing in to support it. That's what's going to happen. But you should assume it's not going to keep up with inflation. Hey, Steve, I appreciate the content. Awesome. I'm glad you're here. Wanted to ask if it's possible that bond yields can keep going lower. Yes, they can, reaching new lows throughout years. Well, I don't know how much farther below zero they go, because the whole system, I think, starts to grind to a halt. But I think this year we see zero. So I'm going to, how about reaching new lows throughout this year? I would agree with that. Also, greedy macro question, are financial institutions not considered smart money? Yeah, I consider large commercial banks to be smart money. Absolutely. I guess what I'm really trying to figure out exactly how the Fed makes its purchases. The name Federal Open Market Committee makes it seem so, as it acts as a regular trader, i.e. open market. That would make sense. Placing a bid at market price. Is this the case, or do they go through a special channel? They do go through a special channel. The Fed does not purchase Treasury securities or mortgage-backed securities on the open market. They purchase them directly from the large commercial banks. It's auction style as well. They're going to go to them and say, hey, we're going to buy this much. Who wants to bid? And obviously, they're going to take the highest bidder on that. So yes, that we'll just say through a special channel. Can I also ask what effect this would have on corporate bond yields? So normally what we would expect is bond yields to go down so corporates should go down as treasuries. Now, when you get into deflation environment, this is interesting. You can have treasury yields go down and corporates go up. How is that possible? Well, think of it this way. If your corporate balance sheet is a mess, right, because your revenue is down, which means your profits are down or maybe negative, and your debt cost is going up because real yields are rising, inflation adjusted yields are rising. Well, what does that mean when you go to refi your debt? And there's a record amount of corporate debt refined this year through over the next through 2025. So why would rates on corporates go up? Risk premium. So yeah, in deflation environment, corporate debt can go up, corporate bond prices can go down while U.S. Treasury yields go down and Treasury bond prices go up. So I'm Steve Van Metre. Thanks for joining us today, and we'll be back on Friday for our kind of not weekend, but end of week wrap up. And then if you have questions for the Monday Spectacular, please come to me by wherever you live in the world, end of midnight Thursday. How about that? That way I have time to get them into my system. And again, on Monday, I give back to you. You supported me. I support you. Your questions answered. We're going to go until I have no more to ask. I'm Steve Van Metre. Thanks for watching, and I will see you on Friday. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation by a seller, security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that I do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.